Welcome to This Explainer. Today, we're diving into some basic financial concepts you absolutely should understand. We're going to look at the modern economy, which, if you think about it, is essentially a massive multiplayer game with very specific and honestly often hidden rules. Picture this. You just had a brutal month at work. You're slaving away, giving it your all, right? You're lying in bed and you get that email saying you've finally been paid. Best feeling in the world. But then, the universal shock hits. You check your bank account and realize your paycheck somehow shrank before it ever even reached you. It's this jarring reality that most of us just kind of accept. But what if we actually unpacked the mechanics behind it?
To win this game, we really need a complete map. So here's the plan. 1. The reality of your money. 2. Banks, borrowing, and credit. 3. The invisible wealth eaters. And 4. How to build real wealth. Let's get right into it.
All right, Section 1, the reality of your money. We've got to understand the board we're playing on.
Okay, let's go back to that paycheck shock for a second. Imagine you spent the whole month flipping burgers. The gross amount you earned, what that glorious email says, is $2,000. But the reality? Your bank account only receives $1,456. This right here is the modern ritual of giving away a chunk of your money to invisible forces. And honestly, the crazy part is that society expects you to just smile and say thank you for it.
So where on earth did that money go? Well, it went to taxes, which are essentially the cost of civilization. It's what pays for the government to build roads, fund schools, and, make sure your favorite taco truck isn't infested with rats. You've got income tax on the money you make, sales tax on the money you spend, and capital gains tax on the money your investments make while you sleep. But you'll also notice Social Security and Medicare in there. Social Security is basically the government forcing you to save money right now so they can pay it back to you when you retire. And Medicare? That's a health insurance tax supporting older folks and those with serious health issues. Yes, filing them is totally annoying. It's this bizarre system where the government absolutely knows what you owe but makes you guess anyway. And if you guess wrong, you're cooked. But to be fair, countries with higher tax rates generally do enjoy a higher quality of life.
What's really fascinating, though, is what's left over, your money. But what is money really? The weird part is that currency isn't actually real. It's a social construct. Literally, there is no more inherent legitimacy to a dollar bill than there is to a stick you find in the woods. The only difference, the only reason a dollar bill can buy you groceries and a stick cannot, is our shared belief and trust that the dollar holds value. The government prints it, central banks regulate it to keep it from turning into monopoly money, and we all just kind of agree to trade it.
Let's build on that and see how this concept actually generates wealth. Look at gold. At the end of the day, it's just a shiny yellow rock. It isn't inherently worth more than the average gray rock sitting in your driveway, except that it's rarer and humans have placed a much higher perceived value on it. Understanding this perceived value is absolutely crucial. It's the true secret to generating wealth. Think about it. Steve Jobs created massive perceived value with the iPhone, so millions of people gladly handed over thousands of dollars for it. It's the exact same reason Gucci can sell a handbag that functions just like a $20 one from Target, but charge 100 times the price. If you can figure out how to create value, even if it's just perceived value, you generate wealth.
Moving right along, Section 2, Banks, Borrowing, and Credit. Let's uncover the middlemen.
When you walk into a bank and deposit your hard-earned cash, you might imagine it goes into this massive steel vault guarded by a dragon, just waiting for you to return. In reality, the moment you deposit $1,000, that money is mostly gone. Banks are essentially financial matchmakers. They use a system called fractional reserve banking. They keep a tiny, tiny fraction of your money on hand and just lend the rest out. So they might take $900 of your deposit and lend it to some guy who really wants to buy a jet ski. They only keep a fraction because they know, statistically, not everyone will ask for their money back on the exact same day. And hey, don't worry about the dragon. In the US, the government insures your deposits up to $250,000, making it way safer than stashing it in a shoebox under your bed.
So, the crucial point here is, why do banks even do this? The answer is interest. Interest is simply money's way of charging rent to exist in someone else's hands. When you borrow, it's the price tag for using someone else's cash. When you save, it's your reward for being patient. Now, there are two main flavors here. Simple interest is like saying, here's a flat fee, thanks for playing. But compound interest? Oh man, that means every dollar you have right now gets clones, and then those clones also want rent.
And this brilliantly illustrates the sheer danger of compound interest when it's working against you. Imagine you have a credit card with a 20% compound interest rate. You buy a $12 burrito and oops, you miss a payment. Suddenly, your interest is earning interest. Before you know it, that $12 lunch turns into a $50 regret burrito. It's this slow burn that turns small, innocent mistakes into raging financial fires.
Which leads directly to how the game judges you, your credit score. Ranging from 300 to 850, it is essentially a shadowy trust algorithm that knows your entire past and decides if you get to buy a house or if you get slapped with a soul-crushing 27% interest rate on a new TV. If you're anywhere below 580, you are a walking red flag to lenders. But if you cross that 750 mark, you, my friend, are sparkling with adult credibility.
Now, it's super important to realize this score isn't about your actual wealth, like, at all. It's entirely about looking good to lenders. You could literally have zero debt and still have a trash score if you have no credit history. Yes, the game is rigged, but here are the cheat codes to rig it back. Payment history is huge. Always make your required payments before you enter that late period. Keep your credit utilization low compared to what's available to you. Maintain a long credit age. Have a healthy mix of cards and loans. And please, don't apply for too much new credit all at once. Basically, treat your credit score like a pet dog. Take care of it, and it'll help you buy a house. Ignore it, and it poops all over your life.
All right, Section 3, the invisible wealth eaters, the environmental hazards of the game.
Have you ever grabbed a bag of your favorite chips and realized you just paid 30% more for a bag that's half empty? Yeah, you've been hit by inflation. Inflation is the slow, quiet erosion where your money gets less and less valuable over time. That $5 bill in your wallet is still technically a $5 bill, but it buys less gas and fewer instant noodles than it did 5 years ago. So what causes it? Sometimes it's too much cash chasing too few goods. Like if 2,000 people want a TV, but there are only 1,000 TVs out there, the price skyrockets. Other times it's supply chain hiccups making the actual production expensive, and sometimes it's just a self-fulfilling prophecy. People expect prices to rise, so they rush out and spend faster, which actually drives the prices up.
Now, a little bit of predictable inflation, usually around 2% a year, is actually totally normal. But when inflation spikes, your savings essentially die and your wages start lagging way behind. To fight this, the government has to step in and raise interest rates. This makes getting a loan way more expensive, meaning people have less money to spend on things like new TVs. And that reduction in spending is what cools off the entire economy. But when the economy cools off a little too much, boom, we hit a recession. A recession is simply defined as the economy decreasing for at least 2 quarters, which is 6 months. Think of the economy like a massive wild party. During the boom phase, everyone is dancing, buying overpriced coffee, having a great time. But eventually, reality hits. Someone checks their bank account, the lights come on, and suddenly the DJ's playing sad lo-fi beats about corporate downsizing. Jobs vanish, and companies ruthlessly cut costs. It can be triggered by high interest rates, a global pandemic, or sometimes just the economic cycle resetting itself. It's undeniably painful, but it's a temporary reset before growth eventually resumes. Which brings us to our final part, Section 4, How to Build Real Wealth, the Investment Cheat Codes. Because inflation is constantly, quietly eating your cash, just sitting around doing nothing is incredibly dangerous. You have to trade your money for more money. That's what investing is. Here are the basic vehicles you need to know. Stocks. Those are tiny ownership slices of a company. If the company grows, your slice grows. Bonds are basically you loaning money to a government or a corporation, and they promise to pay you back with interest. Funds are collections of stocks and bonds, sort of bundled together, so you don't have to stress over picking them one by one. And real estate is property you buy hoping someone else pays to live in it. The real danger here isn't the risk of the market going up or down. The true danger is never investing at all and letting inflation quietly steal your future. There's a great saying, wealth isn't built in days, it's built in decades. Investing is not about getting lucky, it's not about winning the lottery or finding the next viral meme coin. It's about being early, being diversified, and above all, being insanely patient. It's about letting that compound interest we talked about earlier act like a positive time bomb, turning small, consistent gains into massive wins. If you invest at a historic average like a 7% annual compound interest rate, your money acts like a total cheat code. It duplicates itself over 30 years until you wake up old, rich, and honestly a little smug about it. And that brings us to the ultimate wealth multiplier. Time. Time is, without a doubt, the most valuable asset in the world. We all start out the same way, trading hours directly for a paycheck, 1 hour worked, 1 hour paid. But the top earners? They figured out how to train their hours to work for them in the background. A little bit of consistent money, given enough time, becomes an absolute fortune. You really don't have to beat the system to retire with 7 figures. You just have to know how to use the system. So, as we wrap up this explainer on these basic financial concepts you should absolutely understand, I want to leave you with one final, provocative thought. Interest is either your worst enemy or your best unpaid employee. Take a hard look at your own life and ask yourself right now, who is collecting the interest on your time? Are you just paying it out to the system, or is it compounding for your future?